Alright, so hi guys. How are you feeling about the stock markets recently? Feeling good about it? I don't think so. If you're like most people, you're probably feeling really lousy about the markets and your portfolio probably is down the last couple of months. You're not alone. In fact, a survey of individual investors in America found that the level of bullishness is extremely low. In fact, right now, only 15.8% of investors, retail investors, are bullish and 48% are bearish. And the level of bullishness has not been so low and bearishness so high since 1992, 30 years ago. So again, currently the level of bullishness is at 15.8%. If you take a look at the statistics going back 30 years, the only time it reached this low was back in 1992. So why are people so bearish right now? Well, who can blame them? You've got a confluence of a lot of things, right? You've got sky high inflation now above 8%. You've got the war in Ukraine, which is exacerbating this high inflation because of rising energy costs and commodity costs. You've got a Federal Reserve that needs to bring inflation down. So they are going to raise interest rates more aggressively, and quantitative tightening, which is going to suck up liquidity out of the market. So that's causing a lot of stocks to go down the last 3 to 4 months, especially companies in the technology sector and consumer discretionary sector. The market can't seem to sustain much bullish momentum as well. So again, from the start of the year, we had that very strong downtrend, and then we broke above that downtrend resistance in mid of March, and we had a very strong rally going up, but then we started coming back down again. Right, we retraced all the way back down, and right now we are actually at the 50 moving average on the S&P 500 and right at the 50% Fibonacci level. Now, what was interesting was a day ago, the market actually closed with a bullish engulfing candle that said, hey, maybe this retracement is done and we are ready to rock and roll. We are ready to rally again. But then after this bullish engulfing pattern yesterday, we had a bearish engulfing pattern now overriding that bullish engulfing pattern. It's kind of like you're playing Uno, right? It's a reverse and someone puts another reverse card to reverse your Uno card. So for now, it looks like this bearish engulfing pattern, we could see some more bearishness in the short term. Yeah, and sure, we could go back down and retest the lows in March. We could. All right, and that's the S&P 500, and it's down about 8% so far this year. How about the NASDAQ? The NASDAQ is even more bearish, right? But very similar pattern. We had that downtrend. We had that break of that downtrend, a very strong reversal up, and then we had it hitting the 200 moving average, couldn't break the 200 moving average, and reversing back down at the 61.8% Fibonacci level. So right now it's kind of like hanging on there, but again, it closed with a bearish engulfing pattern. So right now, if you ask me, it's kind of like 50-50 in the short term, right? It may bounce back from here, but it could still go back down, especially after that bearish engulfing candle. So everything looks bearish, right? We've got bearish news, we've got bearish markets, but you know something? I'm actually pretty excited about what's going on right now, and I'm actually very, very bullish in the medium to longer term. Now, first and foremost, if your portfolio is down for the last couple of months, you are not alone, right? And it doesn't mean you are a lousy investor. It doesn't mean that you made a mistake, because no matter how good an investor you are, your portfolio can't go up every day, every week, every month, every quarter. There will be ups and downs. It's just part of the game, right? So my portfolio itself, well, let me show you my portfolio, right? Now, to be fair to my paying subscribers that subscribe to my UIP, the Ultimate Investors Playbook, they get to see my entire portfolio, line by line. They see my portfolio review every single month. So to be fair to them, I can't show you all my positions, or they're going to say it's not fair. So I can only show you some of my positions, but I can show you my performance to be fair, all right? So it's one of my portfolios, and year to date, I'm down about, let's see, well, I can just bring it up here. Let me just log in. Yeah, so year to date, you can see that I'm down about 18.9%. So, am I concerned? Am I upset? Of course not. No worries, right? because this is not the first rodeo. This is not my first rodeo. No. I've been in the markets for so many years, and every time my portfolio is down, it goes back even higher eventually, right? Now, the S&P 500 is down 8% so far this year. And my portfolio is down 18, or rather almost 19% so far this year. So I'm kind of like underperforming the S&P in the short term. And again, there's no worries, because historically, every time my portfolio dropped and underperformed the S&P in the short term, it outperformed even more in the long run. So let me show you my performance report over a longer period, because in the short term, anything can happen, right? And it's in the longer term that's what's important. So I just printed this out. This is a statement I just printed out today. Boom. And this is the last 3 years. Okay, so yep, that January to April 13 as of 2 days ago. That's the latest I can get. And this is my portfolio. So the blue one is my equity curve, and the green one is the S&P 500. So again, like you can see, in the last few months, year to date, my portfolio is down almost 19%, right? A lot more than the S&P, which is down only 8%. So in the short term, I'm underperforming. But if you look at the longer term horizon, over the last 3 years, you can see I way outperformed the S&P 500. And in fact, for example, you can see the COVID crash, same thing. My portfolio went down as well. All right, you can't go up all the time. It has to go down to go higher. And in the last 3 years, I'm up about 118%. So that's about 39% return a year on average, right? So like I said, as an investor, your portfolio is kind of like the markets. Remember that the markets, again, they don't go up in a straight line like that, and neither will your portfolio. It's impossible, right? If you see anyone's portfolio go up like that, it's a scammer like Bernie Madoff, right? That never goes down, right? So in reality, your portfolio is like the markets. It has to breathe in order to breathe out, right? Breathe out, breathe in, breathe out, breathe in. And you know something? The deeper it breathes in, the further it will breathe out, provided you're holding good businesses, you're holding great companies. So while many retail investors may be feeling concerned or lousy about the markets, I can tell you, I'm actually feeling very, very excited right now. Let me tell you why. You see, the way I've been making money over the years is that I buy great companies when they are selling at a big discount to their intrinsic value. Usually, only a few great companies will be undervalued. But very rarely will many great companies be undervalued. You know what? It's happening now, and it's really rare. The only time I've seen this happen is back during the 2008-2009 great financial crisis, and during the trade war in 2018 for some companies, and of course the COVID crash in March 2020. During those times, many great companies were undervalued. So it's really rare that this happens, and it's happening right now. A lot of good companies are very undervalued, and that's what's getting me excited, because every time this has happened in the past and I took advantage of it by adding shares, that's when I made the most money. Remember, the more it breathes in, the more it'll breathe out, but only for great companies. And I'm going to show you a few examples right now. So here are a few examples of some great companies that are very undervalued. Now, how do I define a great company? It's one that is able to consistently grow their sales, profits, and cash flow over the long run for at least the last 5 to 10 years. These are companies that have got little or no competition. They've got a wide economic moat, a sustainable competitive advantage, and very low debt. These are great companies. So first on the list would be Amazon. Amazon has an intrinsic value of about $3,668. Now, of course, if you want to learn how to calculate intrinsic value, do take our value momentum investing course, or you can take a CFA where you learn how to do a discounted cash flow analysis, right? But the point is this. So Amazon's worth roughly about $3,600, and it's currently selling at $3,000. So it's 18% undervalued. And if you take a look again at the long-term history of Amazon right now, from a chart perspective, you can see that it actually hit the 150 moving average on weekly candles. How often does this happen? Not that often. You can see that it's not that often that it even touches the 150-day moving average. This has only happened very rarely. In fact, let's take a look. It's only happened like about, in the last 10 years, 1, 2. It's only happened twice in 10 years. So it's a very, very rare opportunity to buy Amazon so cheaply. Now, some people think that Amazon's expensive because they look at a PE ratio. Now, don't be fooled by Amazon's PE ratio, which is, let's see, Amazon's PE ratio. Let me look for it here. That's right, okay? Its PE ratio is 46 times earnings. So people say, hey, that's really high. Don't be fooled. For Amazon, you cannot look at their PE ratio, which is based on net income, because Amazon, they artificially depress their earnings. Bastards. So they show very low earnings so they don't pay much taxes. And the other reason, of course, is because they make a lot of money, but instead of letting it flow to the bottom line, they throw it back into a lot of heavy investments to strengthen their competitive advantage. So for Amazon, like I said, you can't look at profits. You have to look at operating cash flow. Or you can look at the price to sales ratio, which is a more accurate valuation measure, right? If you look at the price to sales ratio of Amazon, it's only 3.32 price to sales ratio. Now, in comparison, Tesla has a price to sales ratio of 18 times. Nvidia has a price to sales ratio of 20 times. Twitter has a price to sales ratio of 7 times. So relatively, Amazon is freaking dirt cheap, all right? And again, if you look at Amazon, it's a company that consistently over the long run grows its revenue. Take a look at that. Revenue growth consistently in the long run, right? Operating cash flow growing consistently, as well as free cash flow growing consistently. There was a drop in the last 12 months on purpose because, again, they invested heavily in capital expenditures, but that's temporary, right? So once that is over, their free cash flow will explode once again. So again, Amazon is one example, dirt cheap. So I've been consistently buying Amazon at these levels, right? Another example is Adobe. So again, if you look at Adobe, it passes the steps or criteria of a great business. It has got hardly any competition that is able to offer the same suite of products as it does. It controls 90% market share of the professional creative market. And again, look at it. In the long run, the sales revenue is increasing, profits are increasing consistently, and so is their free cash flow. And again, they're a company with relatively very low debt compared to the amount of cash which they own. And if you look at the charts, again, the intrinsic value of Adobe is $612. Now again, my valuations are actually very conservative. If you actually look at Morningstar that does a valuation, it's a lot higher than mine. So mine is already with very low conservative projections, right? But even then, I get a valuation of $600. That's what it's worth. But it's now selling at $420. So it's 32% undervalued. And again, how often does this happen? Very rare. If you look at the chart of Adobe going back 10 years, you can see right now Adobe has retraced to the green line, the 150 moving average on weekly candles. Now, how often has this happened in 10 years? It has only happened once here. In fact, it was close to the 150 in the 2020 crash. And again, it happened back in 2016 where it went near the 150. So it only happened again twice in 10 years. Very rare for it to be so darn cheap. And again, there are many other examples. Maybe I'll show you another example. Facebook, all right? Let's look at Facebook. Meta. And again, if you look at Meta, Facebook, look at the sales and profits. It's crazy, all right? Sales are growing consistently. Profits are growing consistently. Operating cash flow growing consistently. In fact, free cash flow increased like 60% year on year, all the way up, right? So this is a great business, no doubt about it. But the stock price got hammered, right? Because all this negative sentiment and overreaction to certain kind of news. And again, if you look at Facebook, the intrinsic value conservatively is about $403. And this doesn't take into account their metaverse project, which to me is a bonus. So even if it fails, who cares? This valuation is based on the free cash flow generated from its legacy applications like Instagram, Facebook, and WhatsApp, right? And again, it is currently at $210, so it's like almost at a 50% discount. And on the charts, you can see that Facebook is trading below its 200 moving average on the weekly candles. How often does this happen? Not that often. The only time this happened was during the COVID crash and during the Cambridge Analytica scandal back in 2018. So you can see a huge upside potential back to its fair value and beyond as Facebook starts to grow. On a PE ratio basis, Facebook is selling at 15 times earnings when they are growing their cash flow and earnings by 40, 50, 60%. So it is really dirt cheap. Now, as always, this is not a recommendation or advice for you to buy any of these stocks. I'm just telling this to you because this is how I think, this is how I invest. I'm sharing it purely for educational purposes. So please, if you want to invest in something, you got to do your own research. But I'm just sharing with you my thought process. Now, it's not just technology stocks that are undervalued. There are some really good businesses that are non-technology, especially those in the consumer discretionary sector. For example, Domino's Pizza, very undervalued right now, great business. Starbucks, what else? You have got Nike. These are very good businesses, undervalued as well. So what is causing this big sell-off in the markets? Well, of course, you've got that Russia-Ukraine war. That's one thing. But the other main thing is the rising long-term interest rates. The yield on the 10-year bond is rising. So when the long-term interest rate rises, it increases the discount rate used to value companies. So when the long-term interest rate goes up, discount rate goes up, intrinsic value goes down, but it only affects companies that are unprofitable now. So companies that have sales but no profits, they make profits in the future, will be the most badly affected by these higher long-term interest rates. So you can see over here, the 10-year bond, right, has been going up all the way, right, from 0.5% now to 2.8%. How much higher would it go? My guess is it could go up to 3 to 3.5%. But thereafter, you can see long term, it's on a downtrend. It will revert back down eventually, but it will still go high in the short term. So again, as this goes up, companies that are not making money, that are unprofitable, will get whacked the worst. But then you may say, but Adam, in that case, Adobe's making money, Amazon's making money, Facebook's making money. Why are they going down? Well, because the baby is getting thrown out with the bath water. So what I'm saying is that this is a great opportunity to buy companies, only the good ones, only the ones that are profitable, because these are the ones that are going to bounce back up very strongly once the yields start to taper off and come back down. But companies that don't make money, that are unprofitable, that are driven up purely by liquidity and the Fed, those may not come back, or those may take a long time to come back up. So a few examples of these companies to be careful about, again, are companies that are not consistently profitable, like Teladoc, right? A lot of the companies in the ARK ETF are these kind of companies. I've mentioned this before, and that's why I said be careful of ARK ETF many months ago. For example, if you look at Teladoc, it's one of those companies, right, where, yeah, sales are growing, but they're not making money. They are losing more and more money every single year. So their stock price is pumped up by liquidity. Without liquidity, it's worth nothing, right? Another example is NIO. Of course, people are excited about electric vehicles, going to change the world. Yeah, but ultimately, is it making money? No, it's not. It's not making money yet. Will it make money one day? Well, hope so, but you don't know, right? So again, sales are going up, but they are losing money. Another example is C, which owns Shopee, right? So again, losing money. These are all companies that can't survive without liquidity in the markets. Take out liquidity, they all fall because there's no earnings, no cash flow to back up the share price. Now, I'm not saying that the market is going to go up tomorrow, right? I'm saying that great companies are looking cheap, and as an investor, it's a great opportunity to buy stocks, in my opinion. But as always, I tell my students, never buy at one go. Always buy in tranches, buy in stages, average in, slow into the markets, because it could still go down in the short term. In fact, if you look at the charts again in the short term, we may still have a bit more downside, possibly. Why? Because we close with a bearish engulfing pattern. Remember, reverse Uno card, reverse that reverse. So we could go down and retest those lows, you never know, right? So what do I do as an investor myself? So in my investment portfolio, great companies I hold, I just hold it because it's going to go up eventually. Plus, I add more shares along the way, all right? But at the same time, when I see the market going down temporarily, I'll use options to short the market and make some short-term profits during the short-term downtrend. So for example, if you, again, take a look at my portfolio over here, right, you can see I have a few bearish option trades. Like I've been bearish on the QQQ, which is the NASDAQ ETF for the short term. You can see over here, I do have a short position, small short position, right? I bought a bear put spread on the triple Qs. I'm also short on Alibaba. Some of you say, what? You're shorting Alibaba, you bastard. You told us to buy. Okay, hold on. I have Alibaba shares. I'm holding it because I think it's going to double and triple in price eventually, right? But short term, it may still go down the short term. So I'm shorting Baba using options, right? I've made some money from there, all right? Like for example, these are my Baba trades, right? So in fact, I just closed one, right? Small profit. I just opened another Baba bear put spread, right? So I've got a long-term investment position, but I do trade around that position sometimes if there's a short-term downtrend. So that's how I manage my investments and my trades. Now, am I the only crazy guy who is seeing this as a buying opportunity? No. Guess who else is buying stocks right now aggressively? Corporate insiders. Corporate insiders are people who are working in those companies. They are working in Facebook, they're in Apple, in Nvidia, they are working in all the companies, and they are buying shares aggressively with their own money. Now, this is not shares that the company gives them. These are shares that they buy with their own cash that they have. These are not share buybacks. It's not the company buying back shares. These are the actual directors and staff who are buying shares on their own accord. And if you take a look at where we are right now, corporate insider buys are at a huge high, right? And this doesn't happen that often, but every time you see huge insider buying, it means the insiders know that their companies are dirt cheap. That is a great deal, and that is when the market starts to take off, as you can see historically. Remember when I first started this video, what was the first chart I showed you? I showed you that right now, bullishness in the market is the lowest it's been in 30 years. Right now, only 15% of retail investors are bullish, very, very low. And the only time this has happened in the past was back in 1992. So what happened in 1992? Well, if you take a look at history of the S&P 500, you can see that in 1992, we had also a correction over here, another correction over here, another correction over here, right? 3 corrections. So people getting fed up, market goes nowhere, keeps going down, sell. And the moment they sell, boom, it goes up, right? Comes down again, oh my God, sell, sell, boom. So it pays to be bullish when the majority are bearish. That's where the big money is made. And that's why, Warren Buffett always says, the stock market is a device that transfers wealth from the impatient to the patient. So you gotta be patient and you gotta understand the businesses that you invest in. If you invest in good businesses, no worries, mate. They may go down in the short term, they will always go higher. So use it as an opportunity to add more shares instead of being worried and frustrated and panicking. But of course, if you hold lousy companies that are losing money, then, well, that's another story. Get rid of those, buy good companies instead. Hope you learned something. May the markets be with you, and I'll see you in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.